In this tutorial, I'll be teaching you about LGND stock. I'll copy that and paste that in Google and write stock beside it. And you can see the name from Google, and also you can see the market cap, which is in billions, and which means it's a big size firm. And you can see the dividend yield. It doesn't pay out any dividend, and um, if a company pays out dividend, that means that they have extra money after paying their loans, their liabilities, their costs. They still have money left, which they paid to their shareholders. And this is a positive sign because they're doing financially very good, that they are able to generate enough money that they can pay off extra money. So this company don't pay out dividend. This means that maybe they're not able to generate enough money that they have extra money left after paying their loans and everything. But if uh, it could be that they are, instead of, they still have, because there are many firms that don't pay dividend yield, but they're doing financially very good. It could be that they are investing back in their firm to grow, instead of giving to shareholders. So it's like, you have to decide that. So it's just one factor to look at it. And you can see that if somebody wants to buy the stock right now, they will be buying it for 112.4 US dollars. So everything you can get from Google, and you can see that it's founded in 1987. And you can just go to Wikipedia, and I love the box here because this has very good information. You can see the box founded September 1987. And I'll just go back. I will copy the exact name from Google, and I'll type it in here, and I'll say Indeed reviews. And I want to see what the employees have to say about it. And I can see there are 3 reviews, which is not much to judge a company, and it's 4.7 stars. But 3 reviews is not enough that I can say that it says a lot about the company. So I'll just go to Glassdoor as well. And in Glassdoor, it has 1 review, which is not a lot, and it's 3 stars. So it's very difficult to judge. But I'll go to Yahoo Finance, and I want to see who the key executives are and what are their salaries and everything. So make sure that the symbol matches the name as well, and go to profile, and sector is healthcare, industry is biotechnology. You can just see from here. And there are 116 employees, which is not a lot. You can see the key executives. You can see all their salaries have been shown except the director of corp development. That salary is not applicable. You need to search why it's not applicable. You need to find out, maybe another website has covered that. So because the more information we have, the more transparency, the more better it is. Then just go to Justia Patents, and this website is about patents. And you can just search it on top. And you I'm not interested in inventor, because these are people who invented but they don't have full rights. I'm interested in applicant or assignee. And I can see 2012 there's a patent, 2008 there's a patent, and 2010 there's a patent, and 2003, um, yes, 2003 there's a patent, and 1999 there's a patent. And you can just go through the list yourself. And 2017, which is a recent patent, make sure they have recent patents, because 2015, 16, 17, 18 they have recent patents, because that means they're still trying to innovate, they're still innovating, they're still competitive, they still have a moat, and they have competitive edge. The more patents they have, the better, because the more stronger the company is against its competitors. And make sure to look out for recent patents as well, which is very important. And right now I want to go to Macro Trends. It's a brilliant website for ratios. And this website, I've left the link, but please ask me if there's any questions you want to ask, because I'll try to help. You just go to price ratio and price book ratio and paste in the symbol. This website takes a little bit of time. You need to be patient with it, because it takes time to load the information, because there's a lot of data. So you need to be patient. It won't appear just uh, you know in one go. but it's brilliant website because you don't have to calculate anything. You don't need to know the formulas. It's very simple and easy to use. So let's see. Okay, so you can see book value is the real value, stock price is the market price. If the book value is $1, stock price is $2, that means you're paying $2 to buy something that is $1 worth. Price book ratio. If it's less than 1, that means that the stock is at discount, it's cheap, it's you can buy it at bargain, which is brilliant. If it's 1, that means that it's same, you're buying it at the same worth, so it's not expensive. It's if it's more than 1, that means stock is expensive. So right now it's 2.05, which means the stock is 2 times more expensive. So somebody who buys right now will be paying twice amount to buy that. So if somebody bought it in 2011, they paid 113 times more money. So if you just see vertically up, you can see that somebody who bought that time in September 2011, they paid $13 to buy something that was only $0.12 worth. So they bought it very expensive. And but it was most expensive in 2008 when somebody paid $17 to buy something that was $0.12 worth. So you need to be careful about price book ratio. Right now it's only twice more expensive, so it's cheaper than in the past, but still it's twice expensive. So it's up to you to decide what you want to do with it. Just go to other ratios now, and we will be looking at current ratio. Now let me explain about current ratio. Current ratio, it should be current ratio. If it's less than 1, that means that the stock is very risky. And if it's like 1.5 or more than that, then it means that the stock is very safe to buy. There's margin of safety and it's ideal to buy. So there's no risk. So you are looking for 1.5 or more than that current ratio. Now let's be patient because it will take time to load. Okay, so we are looking at 1.1.5 or more than that. Right now, it's more than 1.5. It's brilliant. It's a safe stock. Let's look at the previous trend. Has it ever been below 1? Yes, it has. So I can see there are fluctuations. So like in 2016, it has been very below 1.5, and then from 2016 up till I can see 2018 March, it's still below 1.5. From June 2018, it's more than 1.5, and up till now. So it's like nearly 1 year, um, like from June 2018 up till now. So it's 1 year, since 1 year, okay, it has been a safe stock. But 1 year is not a good enough time. Like it should be at least 5 years or 6 years. The time period should be at least 5 years that it has been a, you know, non-risky stock. But it's just 1 year since it has been a safe stock, so it's not a big period to judge on. It's very short term. So you need to look at the ratios at least 5 years because that's a good period of time. Now let's look at debt equity ratio. I'm looking for zero point 0.5 or less than that. Okay, so it's like we are looking at point 0.5 or less than that. Right now it's more than point 0.5. Let's look at the previous ones as well. Um, I can see from 2016 up till 2018 March, it's less than point 0.5, and from 2018 up till now, it's more than point 0.5. So recently, like there are fluctuations. It is more than point 0.5, so it's not a safe stock. It's a risky stock because we are only looking for point 0.5 or less than that, and it has been more than point 0.5 recently. So I would say it's a dangerous stock. Let's go to return equity, because return equity, it should be 8% or more than that for it to be ideal. So it is more than 8%. And if I go back, so there are fluctuations, it's in minus, and it's like, you know, less than 8%. And, just recently, I would say in 2018 March up till now, it's more than 8%. Just a year, like it's been a year now, it's more than 8%, which is good. But I am looking at least 5 years time period. So, if for 5 years consistently it has been 8% or more than that, then that would be good. But it's just 1 year, which is not a, which is very short period of time. So I wouldn't say that it's good. Um, so